Hi, Matthew Marshall here with another Biggin and Scott market update. For more specific information regarding your street or your property, please contact myself or my team at our office. Thank you.
Welcome to RP-Data's update on housing market conditions in Australia for July 2013. Last month we saw dwelling values rise by 1.9% across the capital cities, more than reversing the 1.7% fall over the previous 2 months. With clearance rates remaining high, more buyers in the marketplace, and of course interest rates remaining low, potentially going lower, we do expect the measured recovery to continue throughout 2013. The latest June data takes the quarterly growth rate to just 0.2% after the March quarter posted a seasonally strong 2.8% increase. Dwelling values are now 3.8% higher over the 2012-13 financial year. As a comparison, capital city home values fell by 3.6% over the 2011-12 financial year. The quarterly gains were primarily driven by Australia's largest housing market, Sydney, where values posted a 1.2% increase. Adelaide also posted a 1.2% increase in values over the quarter. However, Adelaide values are only 0.2% higher over the financial year. Perth also posted a quarterly rise in values with a virtually flat 0.1% increase. All other cities recorded a negative movement over the June quarter, with the weakest result being Darwin, where the index showed a 2.7% fall. The end of the financial year has seen dwelling values across the capital city boundaries increase by 3.8%. Every capital city across the country has recorded a rise in dwelling values over the year, apart from Hobart, where conditions still remain weak. Outside of value appreciation, we are seeing most other metrics remain very strong. The average selling time across the capital cities was just 43 days compared with 60 days at the same time last year. That's the lowest average time on market since May 2010. Auction clearance rates are holding firm around the 70% mark across most of the major auction markets, which are once again level with the market conditions around early 2010. Listing numbers are running about 8% lower than a year ago nationally and about 14% lower across the capital cities. While stock levels are reduced, transaction numbers have seen a decent rise. The number of home sales over the 3 months ending April was about 13% higher than the same period a year ago. Melbourne's housing market remains relatively sluggish compared with Sydney. However, dwelling values are broadly rising. They're up 3.4% over the financial year and up by 2.1% over the first half of 2013. Similar to Sydney, auction clearance rates are bouncing around the 70% mark week on week, and homes are selling an average of just 37 days. Transaction numbers haven't seen the same level of pickup as Sydney, with the number of home sales 7.5% higher over the 3 months ending April 2013 compared with the same time in 2012. Local rents have increased by 2.2% over the past year, which has kept gross yields the lowest of any capital city at 3.7% for houses and 4.4% for units. Overall, the Australian housing market has recorded a relatively sedate second quarter. Seasonally, the June quarter is typically weaker than the March, and that is certainly the case this year, with capital city dwelling values rising 2.8% over the March quarter compared with the 0.2% growth rate of the June quarter. As previously indicated, most other market measures remain strong, with clearance rates high, homes selling substantially faster than a year ago, and more buyers active in the market. We've also seen an improvement in housing finance commitments, with the number of new mortgages higher across all market segments, particularly for investors. Dwelling approvals are up 27% over the year, suggesting that developers are starting to respond to the improvement in housing market conditions as well. That's a good sign for the Australian economy, considering the federal budget was looking for a 5% uplift in dwelling investment over the coming year. Importantly, we've seen a lift in consumer confidence in June as well, after confidence levels dipped during April and May. Another factor that's important to note is that despite most market indicators providing a strong reading, the current market conditions are very different compared with the post-GFC recovery of 2009. At that time, there was a great deal of government stimulus with the First Home Buyers Grant boost. First home buyers peaked at more than 30% of all owner-occupier mortgages. Mortgage rates were lower than they are now, even though the cash rate was at a higher level, and value growth was substantially higher during the 2009 growth phase. As you can see from the graph, the current recovery phase is much more measured, even though clearance rates and selling time are strong. Looking forward, we maintain our view that the housing market will continue along its recovery path, with value growth likely to be broadly in line with wages growth. Thanks for visiting RP-Data's YouTube channel. Of course, for more detailed information on the housing market, you can visit www.rpdata.com.